Risk disclaimer stating that online education materials are available by Admiral Markets Estonia for a global audience. So if you want to get a corresponding information on charting conditions and any other detail, you should visit Admiral Markets Global, select your country of residence, and contact an appropriate entity. Admiral Markets UK Ltd takes no responsibility for the information accuracy. This is solely my opinion and in no way it represents the actual suggestion for the trade. This is for informational and educational purposes only. And risk disclosure statement stating all possible risks associated with Forex market. By accepting the risk, you're also proceeding further with me. So with having said that, we are ready to proceed. So supply and demand zone. Let's get cut to the chase. So we will be fast with this. We won't use a lot of theory crafting. I want to present you with this great free indicator. And but before I do that, I need to explain what is supply and demand. So the easiest definition of supply and demand is basically that it's how much of price, let's say, we want to sell and how much of price is wanted by buyers. So demand is usually quantity of, let's say, a product or service is desired by buyers. Vice versa, supply represents how much market can offer. So that is the most easiest definition, and it's learned in all schools of economy, so we don't have to go deeper in explaining. Basically, if you want to have a demand, then you want to actually you will sell at a certain price. If you want to go with the best supply, then you want to buy. So when we say that price is in demand, well, the law of demand will say that if all other factors remain equal, the higher the price, the less people will demand that good. So the higher the price, the lower the quantity demanded. Okay, so it's different to supply. A law of supply says that quantities that are sold that will be sold at a certain price, and supply will always show an upward slope. The higher the price, the higher the quantity supplied. Okay, but that's economy. Now, when we translate that to market terms, well, we want to sell at supply, we want to buy demand. That is how we do. Okay, selling at supply zones, buying at demand zones. Well, that's very easy to say, right? But it's different than when we compare it to real life supply and demand. Because you want to buy, let's say, a specific car, you want to buy it lower, right? But you don't have a graph for that. You don't have MT4 platform to show you the movement of price, so actually you can buy a car. You need to negotiate it with the seller. Or there is fixed price and there is no negotiation. In Forex market, you can always hope for a better price. If the price goes up, it will reach its supply and you can sell it. If price goes down, it will reach its demand and you can buy it. So supply and demand in Forex trading represent the zone where a price will possibly react. It's the zone of price action and expected volatility. That's important to know, because the problem is whenever the price is out of equilibrium, okay, the price will need to get into the equilibrium. When supply and demand are equal, let's say, for example, when supply function and demand function crossover, the economy is at equilibrium. Now, usually market is not in equilibrium, but it tends to gravitate towards equilibrium. That is why we have sellers and that is why we have buyers. That is why we have historical versus now moment concept always applied to price action. Always. Price action in Forex repeats itself. It's also important to know then when these levels should hold the price until the zone is broken. When we talk about supply and demand, we don't talk about levels. We talk about the zone. Okay, so supply and demand present, they show us the zone. Level is something different. Level is, level is it's the level, it's specific level. Let's say 100.00, that's the level, right? Important psychological level. But when we talk about zones, we need to mention that zones are exactly that, zones. It can be 15 pip zone, 20 pip zone, 40 pip zone, and it's about charting, how we see the zones. Sorry. Some traders cannot chart these supply and demand zones correctly. Some traders can say that supply and demand is a bit subjective, right? Well, I can agree with it. It can be subjective because it's our own perception what charts are showing to us, and it's our own perception tells us to actually draw those levels of support and resistance where we can see a specific zone. The thing is, we can do that manually, and back in days when there were no so many trading indicators, I did that manually. I charted it manually, and I will show you how I did it. But today everything is going forward, and that's a good thing. So the indicators are also moving forward, and there are a lot of good indicators that can chart supply and demand. I have an indicator and I can share it with you freely. I have a source code, so it's free to share, and basically you will see it's very good and it shows zones how they should be shown. No more subjective thoughts, right? No more subjectivity. So the closer you are to demand zone, well, it's much better to buy or exit your short position. It's simply treat it as standard support, but with a bigger buffer. So let's say, for example, that okay, this is the level, right? So when price gravitates toward the level, you might say, okay, it will reject the level. But if you see the zone, well, then the price may enter within the zone and react in the zone. Okay, in the zone, not at the level. Because at the level is specific level. The zone is buffered. The zone has more pips than 1 pip level, right? So that is why you will always see POC points, and POC points is based on modified supply and demand theory and price action confluence. It's not just supply and demand, it's supply and demand plus many other factors such as price action confluence, historical versus now moment perspective, chart patterns, candlestick, and so on. But it's good to know that it's the zone. Now, Darshan is asking for indicator, and guys, don't just send me an email. Send me an email, and I will send the indicator, because I will definitely forget when we finish with the webinar. I don't know who will ask the indicator, so please send the request to my email. I will send you. This is recorded, it will be uploaded, Elias, so no problem. So just bear with me. So Camarilla MACD uses my POC point of confluence analysis, and you could see today dollar CAD, the analysis that I did, it went 60-70 pips in profit, and well, it's maybe not 70, but it was like 50-60 pips of profit. But it's good because price definitely respects POC points. And I have come to the ultimate truth in Forex market. How can I explain this the easiest way? The best indicator for trading or analysis is the price. So when you ultimately know supply and demand zone, when you know about trend lines, when you know about everything that we do in our price action trading school, then you will definitely know how to chart these zones, confluence points, supply and demand zones. And a good thing is that I really haven't noticed a lot of people and analysts over the internet do that. They usually do standard price action analysis by using a moving average, I don't know, Fibonacci, and so on. The point is you can be successful with it. I'm not saying that you cannot trade successfully. There are good methods, good systems, and if you know a good money management, that is the most important thing, you will be successful. Even if you're not so good in picking up entries, you can be 30-40% successful in picking up entries, and you still can be good trade. Profitable trader. That's because you use good money management. I know a lot of traders who are really good traders, but they love to gamble. And okay, guys, if you love to gamble, then go for it. Maybe you will have a string of lucky trades that will boost you. But you know, I'm talking about professional trading. Yeah, guys, let me just, okay, so we are finished with this. And I need to answer quick questions. A lot of questions, guys, no problem, I will. So my email is tarantulafx@gmail.com. Just send the request and I will get you. Carolyn is saying, sometimes I read too much, I know too much, I cannot enter because I get conflicting signals. Carolyn, the easiest way not to get conflicting signals is that you actually want to follow one and only, okay, who you think is the best, and try to use that knowledge. Or trade by yourself, but don't read anyone else, because you will get conflicting signals. I know. I've been a long-term member of Forex Factory, and back in days when I was very active in Euro-dollar trade, there were tons of different opinions, and I come to believe I only believe myself. So that's the fact. But that is why I'm here to teach you. Just follow me. This is really what I know about, and you will see that it will have a good impact on your trading and your account. Now, in the zone trading, and other questions will be answered after these slides. So let's go step by step. So we want to trade in the zone. That is why I'm saying get the book from Mark Douglas, Trading in the Zone. It's a good read, and you will find a lot of useful information in the book. One of my really favorite books, Trading in the Zone. You probably heard of it. You can read it, go through it, and you will see there is a lot of good information there. Now, in the zone trading, always use historical price action. So supply and demand are always drawn in historical conjunction. You will always see historical versus now moment price action. Well, that history can be short-term history or longer-term history, but it uses the history definitely. Stacking the odds in your favor is actually when you trade in the zone. Because if you stack the odds, your probabilities will be higher. Always. Okay, so you need to stack the odds in your favor. Now moment buyers and sellers versus historical buyers and sellers. That is our historical concept. So the point is, just try to see that zone, try to find it, and you will see a reaction. You will have probably a good entry. Where you will exit, that's a tricky part. But supply and demand teaches us how to get early in the trade, guys. I will give you just an ordinary example. And I don't need charts for this. Now watch how I actually explain this. I'm not a good maybe in painting, but this is very simple. So let's say this is demand zone, right? And price is going towards demand zone. Now, let's say that trader A entered here. Now, trader B, okay, so trader A entered here. Trader B is waiting for EMA or SMA cross. So what will happen 99% of the time? The price will go here, let's say, for example, and EMA crossover will happen here. So this is trader B. So trader B got into a late entry. Now this is what I'm saying, guys. Most of the indicators will lag unless you're trading multiple time frames and so on. Let's say AccuPivot points or other methods. Those are usually those systems that use multiple time frames are not that laggy. But let's say that people are just trading normally, right? And trader A entered here at early price, moving with institutional buyers, while trader B followed retail herd and entered at a later, much worse price. That is the nature of indicators, because in order to give you a signal, EMAs need to lag, okay? EMAs need to lag. So that is why I use EMAs to give me rejections, not as crosses. The only thing that I have noticed to be very good in trading is when price actually crosses an EMA. But that's different thing, guys. We will talk about it other time. So EMA crosses are a no-no. By using supply and demand zones, you will get in the early momentum that was caused by institutional traders, and you will get an early trade, early bird trade. Okay, this is an example. This is just a level, guys. We can see the level. Look at this, important level, right? See, this is important level, definitely. The zone is something different. Remember our price action trading school, session 1, when we talked about candlesticks. So when you take the body and the wick, you will get a zone. Body and the wick. Okay? You will get the zone. That's very good, because these wicks will give you now moment buyers or sellers. Okay? Always try to align the price and the zone. This was a demand zone. You see, the price was bought into. Then there was a breakout of this demand zone, and soon it became a supply zone. Okay, see how it behaves. Now, the thing is, the zone is good if it's fresh one. But if you see a retest, it can also be good. But don't think you should see many retests, because the more you see the retest, the bigger the chance is for a possible break of the zone. Now, these are some terms that we use: distal line, proximal line. So this is distal line, this is proximal line in the zone. The smaller and short-lived the zone, the less significant or stronger it becomes. We will see that on practical example. Look for zones that held the price for a significant period in time. That is why we usually say strong zone or weak zone. In the history, you will see a lot of strong zones. In now moment, you will see probably zones that haven't been retested, so we cannot say that those are strong zones. Swing traders might look for daily, weekly, monthly zones, while scalp traders can watch the zones on lower time frames. The point is, price will react with the history. Now moment reacts to historical buyers and sellers, And that way you are aligning past and present to give you the future outcome. So wicks are very important. Wicks will signify buyers and sellers. Also, don't forget that you can use supply and demand zone in your MTF trading. The point is that intraday traders want to recognize previous buyers and sellers in history, and that way they can actually see a potential chance for a good trade. Also, scalp traders can also benefit from supply and demand trading. Now, these are different types of levels. When you see we will use these terms just to show you, but you will notice that this is actually V-shaped reversal. This is actually a rooftop, right? So you will usually see drop base rally, rally base drop, rally base rally, and rally base drop. Simply explain, when price makes a V-shaped reversal, that's DBD, drop base drop. When price makes a rooftop like this, it continues down, it's rally base drop. When you see a drop, consolidation, another drop, it's drop base drop, and rally base rally is actually consolidation in bullish trend. Okay, so DBD, DBR, and RBD are usually found in V-shaped reversals and rooftops. DBD and RBR are usually found in trends. Simple as that. So here another example of supply and demand, and that is how we actually did it in the past. We needed to chart these zones manually. Okay, you can do it like this. Okay, and actually I will show you how to do manually, but it's much easier to do that by indicators. Same here, you see, you have learned probably this if you ever visited price action trading school, so you probably know. But the point here is that wicks are always signifying fresh buyers and sellers. So if you align these sellers in the history, you will find that actually this is the zone. Especially when in this example, demand zone was broken here, and here it turned, actually here, it turned into supply. See here. Well, these indicators can be used in any other system, and you will see reactions in the zone. But if you want to use it as standalone indicator, you need to filter it, of course, with other indicators, but it will react. So which kind of movement you will get from the rejection of the zone, it's usually pretty much subjective. That is why I have modified supply and demand actually with price action tools. But you can observe it, you can use it. I will show the indicator, so you will see how it charts supply and demand. You will usually see these zones respected. How much extent? Well, as I say, it's always subjective. Sometimes the zone will be respected to the huge extent, such as this one here, you see, but sometimes the zone won't be respected that much, like here. So it's a bit subjective. If we knew about it, we would be millionaires, right? So we need to make decisions. Now watch this chart. This explains how price reacts. Point 1, price quickly drops. So this was a quick drop. Now price reaches the same zone, then rejects, because this is a supply zone. Again, price drops down, rallies, and here again, from this zone, price quickly dropping. There was no retest. Here we can see that the price has started to consolidate, and price quickly got out from this zone. But this zone didn't have any retest. So here at this point, there is no retest. So we usually wait for the retest number 1. So another zone has been formed. This is supply zone, but we are actually waiting for demand zone to be retested. Here, price reaches the same zone, and you see this is the first retest. So we mark it as 1. Another retest we mark as 2. I have found that the first touch of the zone is usually the most profitable, and that is why it's good to remember how many retests a zone have had in our moment. So that is very important, because after 3 or 4 retests, the chance is that it might start to turn and start to break. So that is why we need to count possible number of retests. Good thing is that this indicator does it for you. Okay, it has the ability to actually count the number of retests, and that is very good. It's much easier to trade like this than like I traded in the past. I needed really to count this manually. Now it's much easier. So here, guys, the question isn't another zone between red and green zones. Well, you can say that this can be a zone, but actually, yes, it's a small one. But this is a stronger one here, stronger one. See, this indicator will solve the problem because it shows weak zones, strong zones, it counts number of retests, so you will see. So watch these concepts, guys. In price action, you will usually see rally, consolidation, rally, it's RBR. You will see a rally, okay, base, then drop, drop, base, rally. So those are just forms, simplified forms of price action. Observe how the price reacts to history and now moment. It's very important. Now let's move on to live chart and let's see this indicator, and here it is, guys. That is the indicator. Look how good it looks. Really a good looking indicator. Very, very, very it's coded really. I think the code is very great. It's coded with these colors, and this is actually where you will see verified resistance. It means it has a retest. It has had a retest. You see, one retest. This is untested resistance. So when a price gets here, we can, I think that it will be rejected because this is resistance. It's still untested, so we should look for short trades here. Then this is weak resistance. We don't know what will happen. The price might shoot up and reject, or it can reject here. You see now, Caroline, this is an explanation to your question. Now you know which are weak and untested and verified resistance. See? Weak support, weak support, verified support. This is one-time retest, and here, guys, 4 retests. It's proven support. So when you see 4 retests, you can say that this support really held. It might hold a couple of more times, and then it should break. Okay, it should break. Guys, I see the comment, the sound has disappeared. Can you confirm that you can hear me? Sound is okay. Yes, audio is good. Okay. So the audio is good. I don't know what happened. So see, thanks, guys. The question, Caroline, can you take a look at pound dollar? Okay, I will take a look. But just watch this, guys. Okay, watch this. You see here, 8 retest. What is this, guys? Huge. zone, huge resistance, 8 retests. If you go to daily chart, you will see why. You see a lot of retests, but why? Because this candle, guys, is huge. Look at this candle from here to there. It's huge, guys. So we don't like to see that, but well, it happens. So if you mark these levels here and mark these like this and go here to, let's say, 1 hour time frame, you will actually see it differently, because daily time frame will show that with a much bigger, well, it's a daily time frame, much bigger buffer. The buffer for this zone is 300 pips almost. See? Almost 300 pips. But that's actually, that's the way how it is. So that is why swing traders might opt for 4 hour time frame where the buffer is smaller, and intraday traders can opt for 1 hour time frame when they can see reactions. So that is why I always say I never trade daily charts, guys. I only watch daily for trend, for a general trend. Swing entries 4 hour, intraday 1 hour. Well, very, very, very easy. Here, daily support, probably it's being tested, but it will show you when this candle close, with this daily candle close, it will say verified, retest 1. But this candle needs to close. So 4 hour is suitable for those, as I say, swing traders. For people who want to actually do it on intraday time frames, 1 hour. For scalpers, well, 5 minute, guys, but you will watch a lot of movement in 5 minute charts, depending on volatility, the overall movement, and so on. So my recommendation is use 1 hour or 4 hour charts. You can search for pairs that do not show those big ATR within the zones, big movement in the zones, and try to see how the price reacted. You can always mix it up with stochastics, with other confirmation, but actually you can also use it as exit indicator, because when you see that the price gets here, you might protect your trades. If you are short and you see that price is going towards this support here or here, these supports, you might try to exit, scale out, protect it somehow. So the concept of supply and demand is pretty much very, very useful in forex trading, and it serves to give you the cue for possible trade management and cues where price might reverse. Now Danes is asking me, do you use additional indicators when trading? Of course, I have my own way to give you the analysis, that is Camarilla MACD, but I cannot talk about Camarilla MACD. It's totally, it's proprietary method. But a lot of things from Camarilla MACD are actually found in Price Action Trading School. That is free thanks to Admiral Markets, and you should visit it. So a lot of concepts from Price Action Trading School are incorporated into supply and demand zones. I advise you to try to watch reactions in the zones and then apply stochastic indicator, and the stochastic indicator will give you also additional confirmation where the price might react. try to experiment with different settings, 533, 833, 1437, to see how it goes. I am the creator of Practical Naked Trading Method, and that trading method is actually price action trading school. But because of the nature of Forex market and huge volatility in the last couple of years, I don't trade naked. I use very few indicators, but those are all proven indicators. But just to watch price naked, I don't do that. So no just naked trading for me. I don't like it. I need indicators just to give me cues where the price will react, how I do in my standard daily analysis that you can always read on Admiral Markets, Forex Street, and other websites, investing.com, I don't know, huge number of websites. So the concept that I use for supply and demand is very straightforward, and it can be the basis for you to actually try to understand price action principles better. The problem here is that traders simply don't have the patience to watch for supply and demand zones, to experiment with different indicators, or at least with price action patterns, wicks, to see how it behaves. Traders usually want a straightforward system, a straightforward method to enter the market, to exit the market. All of the systems I have created need to be subjective, because you are guys, we are humans. We cannot trade simply as robots. We need our own judgment. We need to know where to protect our trades. We need to know how to protect our trades. We need to know where to enter, even if the system tells us to enter. We need to assume, is this a logical signal? So systems or methods just serve to give us the better chance, a higher probability to enter the trade. It's not, we cannot trade mechanically. If we see that the price is too high, we know that this can be a good way to short. Combining this with other indicators or with historical concepts, with Fibonacci or other tools, we might decide to enter short. So guys, this would be all. I think I was really concise with this. If you need the indicator, just email me. I will gladly send it over to you. If you have some questions, please go ahead and ask me. Carolyn is asking, I'm looking forward to Heikin-Ashi system tomorrow. Okay. Everything can be combined with supply and demand, even Heikin-Ashi. So if you are interested in this indicator, I would really like that you ask me for this indicator, because it can help you in your trading decisions. Carolyn is saying, if the price is too high but making higher high and higher low, would you still go short or wait for a lower low to be in place? No. The only thing, let's say that this is euro dollar. Now, if I see that the price is going here and I see a rejection, a pin bar, I might go short. But if I see that euro dollar is in uptrend, as we see it, I would always wait for a drop to buy it lower, because buying it lower is actually going with supply and demand. Derek, is the same with Admiral Gravity. I will explain about Admiral Gravity in September during my webinar about MT4 Supreme Edition. So we will talk about it. It's similar, but I need to go deeper in that. Jack is saying your price zone presentation was excellent. Thank you. Thank you. And you're welcome, of course, for thanking me. So no problem. I'm glad that you like it. So guys, this can be additional tool for you that might give you some additional knowledge. And as I always say, I'm always quoting Mr. John Nesbitt. You can find it frequently. That is my really one of my favorite quotes. We are drowning in information but starved for knowledge. So the knowledge is what we need to have. Thank you guys for listening. I will be here with you soon again. I hope that you enjoyed it. And as I always say, trade safe and expect new analysis tomorrow. Cheers, everyone.